0 o'clock to 0:15. Hey everyone, and welcome back to the channel. Have you ever listened to the financial news and felt like you were hearing a foreign language? GDP, CPI, unemployment rates. It can all sound super complicated. But what if I told you that understanding these key numbers is one of the most powerful tools you can have for your financial future? 0:15 to 1 o'clock, whether you're an investor, a business owner, or just someone who wants to be smarter with their money, knowing how to read the economy's vital signs is a game changer. It helps you understand why your grocery bill is going up, why interest rates on your mortgage are changing, or why the stock market is suddenly behaving erratically. Today, we're going to demystify it all. I'll break down the most important economic indicators, show you where to find them, and explain how you can use this information to make informed, confident decisions. This isn't just for Wall Street experts, this is for you. 1 o'clock to 1:45. So, let's start with the big one, gross domestic product, or GDP. Think of GDP as the ultimate report card for a country's economy. It measures the total value of all goods and services produced over a specific time period, usually a quarter or a year. When you hear that GDP is growing, it means the economy is expanding. Businesses are producing more, people are spending more, and generally, things are looking up. This often leads to higher corporate profits and a rising stock market. On the flip side, if GDP is shrinking for 2 consecutive quarters, that's the technical definition of a recession. A shrinking economy can mean job losses and lower stock prices. So, when you see the GDP report, you're getting a bird's eye view of the entire economic landscape. 1:45 to 2:45. Next up, let us talk about something we all feel directly in our wallets: inflation and the Consumer Price Index, or CPI. The CPI tracks the average change in prices that consumers pay for a basket of goods and services, from gasoline and food to movie tickets and clothes. When the CPI goes up, it means your purchasing power is going down. Your dollar just doesn't stretch as far as it used to. This is inflation. Central banks, like the Federal Reserve in the US, hate high inflation. To fight it, they'll often raise interest rates. This makes borrowing money more expensive, which cools down spending and, hopefully, brings prices back under control. So, watching the CPI can give you a major clue about the future direction of interest rates, which impacts everything from your credit card debt to the housing market. 2:45 to 3:30 now, let's connect that to another crucial indicator, the unemployment rate. This one is pretty straightforward. It measures the percentage of the labor force that is jobless and actively looking for work. A low unemployment rate is a sign of a strong economy. When almost everyone who wants a job has one, people have more money to spend, which fuels economic growth. However, extremely low unemployment can sometimes contribute to inflation, as companies have to compete for workers by offering higher wages. A rising unemployment rate, on the other hand, is a classic warning sign of economic trouble. It signals that businesses are cutting back, which can lead to a recession. 3:30 to 4:30. Okay. So, we have GDP for growth, CPI for inflation, and unemployment for jobs. What about the mood of the market? This is where consumer confidence comes in. The Consumer Confidence Index, or CCI, is a survey that measures how optimistic or pessimistic consumers are about their financial situation and the economy's health. Why does this matter? Because consumer spending is a massive driver of the economy. In the US, it accounts for about 2/3 of GDP. If people are feeling confident, they're more likely to make big purchases, like a new car or a home. If they're feeling pessimistic, they'll save their money and cut back on spending. This makes the CCI a powerful leading indicator, offering a glimpse into future spending habits. For 30 to 5:30, now let's switch gears from the consumer to the business world with the Purchasing Managers Index, or PMI. This is one of my personal favorites because it's a fantastic forward-looking indicator. The PMI is a survey of purchasing managers in the manufacturing and services sectors. They're asked about things like new orders, inventory levels, production, and supplier deliveries. A reading above 50 indicates that the sector is expanding, while a reading below 50 signals a contraction. Since these managers are on the front lines of the supply chain, their activity often predicts broader economic trends weeks or even months in advance. If you see the PMI trending upwards, it's a great sign for future economic growth. 5:30 to 6:15. Another area you absolutely have to watch is the housing market. Indicators like housing starts, which measures how many new residential construction projects have begun, and existing home sales are vital. The housing market is a huge part of the economy. A strong housing market creates jobs in construction, boosts sales for furniture and appliance stores, and generally makes homeowners feel wealthier, encouraging them to spend more. A weak housing market can have the opposite effect, dragging down the entire economy. It's also very sensitive to interest rates, so it's a great place to see the real-world impact of central bank policies. 6:15 to 7 o'clock. So, we've covered the big indicators. Now, the million-dollar question, where do you actually find this information? The good news is, it's all public. You don't need an expensive subscription. For U.S. data, government websites like the Bureau of Economic Analysis (B4GDP), the Bureau of Labor Statistics (BLS) for CPI, and unemployment data, and the Census Bureau for housing stats are your primary sources. They are the official providers of the data. 7 o'clock to 7:45. But let's be honest, those government websites can be a little dry and hard to navigate. For a more user-friendly approach, I highly recommend financial news outlets. Websites like Bloomberg, Reuters, The Wall Street Journal, and MarketWatch are fantastic. They not only report the numbers the second they are released, but also provide expert analysis on what those numbers actually mean for you and the markets. Many of them have economic calendars that show you exactly when each report is scheduled to be released, so you can be prepared. 7:45 to 8:30. Another great tool is a good financial data app or website. Platforms like Yahoo Finance or TradingView integrate economic calendars directly into their interfaces. You can often overlay events, like a CPI release, directly onto a stock chart to see exactly how the market reacted in real time. This is an incredible way to learn and see the cause and effect relationship between economic data and asset prices. Start by picking one or two indicators, like CPI and a jobs report, and track them every month. You'll be amazed at how quickly you start to see the patterns. 8:30 to 9:15. Now, how do you put this all together to make smarter decisions? It's about building a narrative. Don't look at any single indicator in isolation. The real power comes from seeing how they interact. For example, let's say GDP is strong, unemployment is low, but inflation CPI is starting to get really high. What might that tell you? It suggests the economy is running hot, and the central bank will likely raise interest rates to cool it down. Knowing this, you might decide to be more cautious with growth stocks that are sensitive to higher rates, or maybe you'd lock in a fixed-rate mortgage before rates go up. 9:15 to 9:45. Conversely, if you see GDP slowing, unemployment ticking up, and inflation falling, that might signal a coming recession. The central bank would likely respond by cutting interest rates to stimulate the economy. This environment can sometimes be better for certain types of investments, like bonds. It's not about perfectly predicting the future. No one can do that. It's about understanding the current environment and positioning yourself to manage risk and seize opportunities based on the most probable outcomes. It transforms you from a passive spectator into an active, informed participant in your own financial journey. 9:45 to 10 o'clock. I know that was a lot of information, But starting to pay attention to these numbers will fundamentally change the way you view the world of finance. It's a skill that pays dividends for a lifetime. Thank you so much for watching. If you found this helpful, please hit that like button and subscribe for more content to help you master your money. I'll see you in the next video.